So the first type of derivative contract or derivative instrument that we'll dive into is futures. So futures contracts, or simply referred to as futures, they're agreements between two parties for the purchase, the sale, and the distribution of an asset at a mutually agreed upon price at a date in the future. And once again, we look back to our wheat example, right? It's an agreement between two parties, and this in a wheat future, a contract where two parties, let's say a person with the wheat, they want to sell, and maybe a person wants to buy it, and they're agreeing to the purchase, sale, and distribution of that asset, let's just say wheat, at a future date. The person doesn't necessarily want it now. They're speculating on the prices that maybe the person buying it will speculate that the prices will go down. Maybe the person selling is expecting the prices are going to go up, so they're looking to take advantage of that price difference. The key thing here is that they both are agreeing to this transaction at a future date. Now, futures act as a contract that specifies the number of units of an asset that will be bought or sold, the price per unit of an asset that will be bought or sold, and the time and date when the asset will change hands. We put change hands in quotation here because in 2022, nowadays it's not so much the actual transaction of the actual underlying asset. Even in oil futures or wheat futures, typically that's not necessarily how the trade is worked. Back in the early 20th century, in the late 19th century, when derivatives contracts were first being used, they were actually delivering the underlying asset, right? But now if you open up a oil futures contract and you're longing it, you're not going to wake up the next morning when the contract's over with a barrel of oil on your front doorstep, right? And the same thing with crypto here. So even if you necessarily buy the contract, you are not going to end up with the underlying asset. You are buying the contract, so to speak, right? Now, they're often used to speculate on the future price of an underlying asset. And once a futures contract has been initiated, both parties involved must fulfill the commitment to buy or sell the underlying asset at the time of expiration. Now, crypto futures contracts are contracts that represent the value of the selected cryptocurrency. Once again, you do not actually own the literal cryptocurrency when you're purchasing a futures contract. Entering a futures contract means that you have agreed to buy or sell a specific crypto at a later date or at a specified date. So there are some differences between spot trading and futures trading, and we'll go through some of these. And one of the biggest ones is the use of leverage. So leverage is the ability to borrow capital to add to your trading positions. There is no use of leverage in traditional spot trading. You have to have all the funds in your own account to trade with, whereas in futures trading and other derivatives, these markets can offer the potential to borrow funds from the exchanges to increase your position size. And as a result, futures trading can be very capital efficient due to the amount of leverage available. We'll talk more about leverage trading and the various mechanisms that you need to be aware of later on in its own section. Another thing to consider is the long and short potential. Now, in spot trading, traders only benefit from the value of the crypto itself going up over time. But in futures contracts, traders can profit from short-term price movements up or down. If you're taking a long position, you're purchasing the asset or contract with the expectation it will increase in value later in time. This is where you'll profit in the difference in price. You agree to sell the asset at a later date when you think it'll be higher in value. You're buying it now and you're agreeing to sell the asset later in time. So let's say Bitcoin's currently 43,000 and you're expecting it to go to 47,000 in the next 16 hours. You're expecting a massive pump. You can enter a long position where you're agreeing to buy the asset now, right? You're agreeing to enter the contract and you think it's going to go up and later, so you're agreeing to sell the asset at a later date when you think it'll go up higher in value. So if you're selling it when it goes to 47K and you bought it when you opened the contract when it was 43K, you made a $4,000 profit. Now, in the other side of this is the short position. This is the position that you would take when you sell the asset or contract with the expectation it will decrease in value, and you would profit off of that difference in price. In this case, you're agreeing to buy the asset at a later date when you think it'll be cheaper. So let's say Bitcoin is 47K, and you have reason to believe that it's going to go down to 43K. What you can do is you can open up a short contract, and this is you're agreeing to buy the asset at a later date. You'll think it'll be cheaper, so you're going to sell the asset now. So you're quote-unquote selling the asset at 47K, and when it drops down to 53K, you will buy the asset, and you will profit off of that difference. Whereas, so if you're selling the asset at 47K and then you're rebuying it back at 43K, you made a $4,000 profit off of that trade. Now, typically, I use the terminology of buying and selling the actual asset because that is the basis of where it comes from. But once again, with futures contracts, we are not working with the actual asset itself. You're working with the contract on what is the speculated price, right? But the concept remains the same. You are agreeing to buy the asset, quote unquote, buy the asset at a later date. You are profiting off of that price difference, whether the prices are going up in a long position or the prices are going down in a short position. More differences include liquidity. So crypto futures markets provide trillions of dollars in monthly volume. The Bitcoin futures market averages about $2 trillion in volume, beating out the Bitcoin spot market trading volume. So there's a significant amount of more volume in the crypto futures market. And some differences between futures and spot prices. So spot price is determined by buyers and sellers through the process of supply and demand. Futures prices, on the other hand, are based on the current spot price and the futures premium. Positive premiums indicate that futures prices are higher than the spot price, and negative premiums indicate that the futures prices are lower than the spot price. So this is where we start to see differences between the prices between the futures price and the actual price of the asset, in this case, Bitcoin. So here's an example. This is Bitcoin. This is actually from CoinMarketCap. And as we can see, when we're looking at the volume, in this particular case, there's about $30 billion in traded in Bitcoin markets in the past 24 hours. Now, this is in spot markets. If we wanted to look towards futures markets, so this is as per Bitcoin futures info.com, and there's a couple other sources as well, but this is a fairly reliable one that's specifically focused just on Bitcoin futures markets. So here we see the total Bitcoin to USD futures exchange volume market share. And what's interesting here is that the total volume, as we can see, is 43 billion. So that's almost 50% more than what we saw on the spot market. So this is considerably higher, right? From 30 billion to 43 billion. That's almost a 50% increase. And what's interesting here is that we're only looking at this from Bitcoin to US dollar. That's not factoring in Tether, Bitcoin to Tether markets or Bitcoin to US dollar coin markets. So this figure could actually be higher if we were to factor in all of the different trading pairs that Bitcoin futures are available. Here we see some more specific details. This is on Binance. So Binance is actually the largest cryptocurrency exchange, the most used cryptocurrency exchange in the world that sees the most trading volume. And as we can see, there's a significant amount of volume, especially on their Bitcoin to US dollar Tether. The Tether trading pair, even more so than the US dollar trading pair. There's almost $15 billion just in USDT futures trading with Bitcoin. And here's some statistics and a quick rap sheet from Binance. This is their stipulations from Binance Futures. They have differences between their perpetual contracts and different coin offerings for futures, how things are delivered in terms of settlement and the period, pros and cons, just different stipulations for using Binance. And there's a lot of different exchanges that offer futures trading, such as Binance, KuCoin, I believe FTX as well, Kraken, and even on several traditional brokerages such as a TD Ameritrade and a few others actually offer it as well, because Bitcoin futures trading is actually accepted on the Chicago Mercantile Exchange, the CME trading. More on futures. So here's an example. Let's say that on August 13th, 2021, we'll say Group A or Person A buys a futures contract for Bitcoin at $43,000 per Bitcoin that expires on October 13th, 2021. Group A needs Bitcoin by mid-October and is concerned the price will rise before the company needs to buy it. Buying the futures contract here hedges the group's risk because now the seller is contractually obligated to sell Bitcoin to Group A for $43,000 once the contract is expired. Now let's assume that Bitcoin rises to 50,000 USD per coin by October 13th, 2021. Now in this instance, Group A can accept the Bitcoin from the seller of the futures contract, but if the group does not need the coin, it can then sell the contract before the expiration and keep the profits. So in this previous example, both the futures buyer and the seller are hedging their risk. The buyer needed Bitcoin in the future and wanted to offset the risk that the price may rise in December with a long position in the Bitcoin futures contract. The seller could have been a person that was concerned that prices may fall and they wanted to sell or short the futures contract that would be attached to the price of Bitcoin at the time of expiration. They are thinking, well, 3 months from now, something might happen. I'm going to short the market. I'm going to sell with the expectation that I can profit off of the price difference. Now, there's also situations where both parties are speculators, which is happening quite a bit in cryptocurrency, right? Cryptocurrency is an extremely speculative market, especially when there's not necessarily a lot of as much trading going on in the other underlying market. There's so much in derivatives trading that, especially in the futures market, that means it's much more money is actually being spent on speculating on the actual on crypto than trading the actual crypto. So in this situation, we have the buyer or the long position that thinks the price will just go up at the time of contract expiration, and then the seller or the short position thinks the price will go down at the time of contract expiration. Not so much looking for the delivery or the buying and selling of the asset. They're just looking to profit off of the price difference at the time of expiration. Now, there are a few ways to exit future contract positions. One of them is offsetting. So this is the act of closing a position by creating another position of equal value in size. So you're just creating another one to supersede the previous contract. You have rollovers. Traders can decide to roll over or extend their position before the contract is over by first offsetting the position and then opening a new batch of futures contracts in the same size but at a different expiration date. And then expiration. This is just simply waiting for the contract to expire. And these are just different things that you want to be aware of if you're going to enter in the futures contract market.